You're a fixed income guy.
Right.
As you watch the fixed income markets, what did they react to? Do they react to Gary Cohn? Do they react to tariffs? Or are there other factors they're really keying off of?
Well, definitely, growth and inflation are going to be the two primary components, right? So the bond markets are going to look back and say, how does this impact growth going forward? How does this impact inflation going forward? Tariffs might have some of that, but that could be, longer term. Uncertainty and risk premia and things like that, certainly. So what we've seen is that the 10-year Treasury yield dropped 3 basis points overnight, went from 288 to 285. Broadly speaking, the markets in fixed income have been relatively calm. Volatility is relatively low. Spreads are not blowing out on this. The market sees a calm. They're very, very opposite from the equity market. And that's why I think that some of the reaction in the markets today and, other asset classes like equity might be somewhat of an overreaction. Now, the risk that there could be more protectionist policies going forward without Gary Cohn is certainly there, but we have to wait for that to really manifest, and so far that hasn't happened.
Jim, if you tried to play political risk over the last 2 years, you definitely did not win. Is it the same scenario this go? Okay,
so I break it down this way. When I think about Donald Trump and his presidency, I think of him as almost like a bond trader. And I think of him as having 3 components to his P&L. One is creating jobs. The other is wages, people getting paid more for those jobs. And the third is the level of the equity market. And those are the 3 points that he keeps coming back to. So any policy that he has, whether it, political, tariffs, trade, or anything of that nature, he doesn't have an ideology necessarily, but to the extent that it feeds back to those 3 critical components, if it feeds back negative, he'll back off it. I don't think that he is absolutely going to press it to the point where it hurts jobs, it hurts wages, and it hurts the equity markets too much. And I think he's going to really be responsive and reactive, I think, to what's happening to those 3 components of what I call his P&L.